So just to remind people who may not have heard about the winter portfolio before on the podcast, back in 2019, when I first looked at this research idea, the UK stock market almanac had shown that if somebody had invested £100 in 1994 and they'd stayed invested continuously for the next 25 years, they would have seen their money grow to £257. And that's excluding dividends. However, if they'd only invested in the market between the 1st of November and the 30th of April each year, that £100 would be worth £341. Conversely, if they'd only invested in the summer months, then that original £100 would only be worth £69. So I decided to take that finding and apply it to UK equities, and in particular the unit trust universe. So I crunched a lot of numbers and looked at the unit trust sectors that invest in UK equities, like UK all companies and UK smaller companies. And I looked at each of the previous 10 years and looked for funds that had not only produced positive returns during the winters, but had also performed consistently. And I looked at where they were positioned in their relative sectors and looked at how that performance has stacked up from year to year, and I actually came up with a portfolio of just 5 funds, and that was called the Consistent Winter Fund Portfolio. Now, I'm not going to go into the constituents of that portfolio. If you want to find out, you can, of course, take out a free trial of 80/20 Investor. But I also created an aggressive version of that portfolio, and I loosened the criteria slightly. So I allowed funds that maybe had a poor winter out of the last 10. So maybe they weren't quite as consistent, and therefore that meant that it was a slightly more aggressive mix because they weren't as consistent from year to year. And I looked at how that portfolio therefore performed over time. So having created these 2 portfolios, each year I revisit to see how they have performed versus the FTSE 100, the FTSE 250, the FTSE 350, for example, over those winter months, and to see whether this trend is really stacking up. And so if you go back to last year's podcast, I'll put a link in the notes of this show where I covered the winter portfolio. If you look at the winter from 2022 into 2023, the winter fund portfolio, the consistent winter fund portfolio, actually outperformed the FTSE 250 by its widest margin since we created the portfolio back in 2019. So that was obviously a good result. And if you listen to last year's podcast, you'll hear me talk about some of the funds in the portfolio, how they'd actually started last winter, so 2023 going into 2024. It actually started the first few days of that period in relatively strong form, and I was actually hopeful that it would prove pretty positive for the winter portfolio this year as well. So having looked at the numbers, I can confirm that the winter portfolio, so when I say the winter portfolio, I'm talking about the consistent fund portfolio, not the aggressive version. By May this year, so the 6-month period from the 1st of November 2023 to the 1st of May 2024, the portfolio was up around 15%, which was quite an incredible result. By the end of the year period, so by the 1st of November 2024, which is just a few days ago, the portfolio was up around about 17.5%. So the summer months has obviously been in cash, so there's been a couple of percentage points increase on that 15% return up until May because the portfolio has been in cash and earning interest. Now, if you just stayed invested in the funds within that portfolio for the entirety of the last year and not gone into cash in the summer months, which is what you do with the winter portfolio, you would have ended up with a return of around about 18% because it had rallied as much as 26% coming into the summer, but the uncertainty around the UK budget started to drag on the smallest companies out there, and that started to hurt the actively managed UK smaller companies funds that sit within that winter portfolio that I created. So the performance started to fall into that budget, and so you've had a total return of 18%, which is actually still an incredible result, and most people would be happy with that. Now, how did it compare against its benchmarks? Well, it outperformed the FTSE 100, which was up around 15.63%. The FTSE 350 was 16.66%. That's the top 350 companies in the UK on the stock exchange by market cap. Interestingly, the winter portfolio did actually underperform the FTSE 250 this year. So that was up 23.25%. So that's more invested towards the sort of larger than mid-cap range of the stock market. So that wasn't hit by the uncertainty around the budget quite as much as the funds within my winter portfolio. But what I would say, if you looked at the last 2 years, the FTSE 250 was trying and failing to play catch up with the winter portfolio. And in fact, the winter portfolio over the last 2 years still outperformed the FTSE 250. In fact, if you look at it over the last 2 years, the total return for the winter portfolio that switches in and out of cash in the summer months and into those funds that I picked all those years ago, it's up 27.15% over 2 years, whereas the FTSE 100 is up at 22.75%, the FTSE 350 is up 22.4%, and the FTSE 250 is up 20.27% over that 2-year period. So if you zoom right out and look at the performance since 2009, which was the date at which I back-tested the original portfolio, because obviously I did it in 2019, so going back to 2009, that 10-year period, and you look at the numbers, including right up until the 1st of November this year, so the last 4 years where we've been in the real world testing this portfolio, the winter portfolio has returned 242.91%. The FTSE 350 is up 150.78%, and the FTSE 100 is up 146.11%. So what it shows is that you can potentially take advantage of this particular phenomenon over the longer term, but there is no guarantee from year to year that you will outperform the indices such as the FTSE 250, because the winter portfolio does tend to follow the FTSE 250, but then does tend to outperform over certain periods, and particularly history shows over those summer periods when it reverts to cash. So it's something that's particularly interesting. But when you look at these statistics, so I'm not just talking about the performance numbers, we've shown over the longer term that it has outperformed by making the switch into cash and investing in particular funds. But if you look at the statistics, so I'm talking about things like alpha, beta, that actually analyze the performance and how those returns were achieved, then the winter portfolio does significantly outstrip the FTSE 100, the FTSE 250 and the FTSE 350. So alpha, which is a measure of the apparent skill that a particular manager has at picking investment winners versus its benchmark, the winter portfolio has an alpha of 5.68. So that's the annualized alpha over the extended period that going back to 2009. You look at the FTSE 250, it's 0.65. The FTSE 250 is 0 because that's the benchmark I've used. And the FTSE 350 is 0.47. So another interesting statistic is beta. So if a fund or portfolio has a beta of 1, what that's effectively telling you is that it moves in line with the wider market. So if its benchmark, for example, was the FTSE 250, if the FTSE 250 moves up by 5%, then it's likely your portfolio will go up by 5% if it has a beta of 1. So what you really want is a portfolio that achieves returns that is moving not necessarily in lockstep with the market. So the returns you're getting aren't a direct result of just what the market's doing. And if you look at the beta for the winter portfolio versus the other indices, then it shows that it actually has the lowest beta out of all of them when you compare, showing that the performance is actually being driven by the allocation itself, not just by the market. It's actually being driven by the decisions being made. Moving on to one or two others, the return, obviously, the annualized return is 9.7%. That is much higher than the FTSE 100, which is 7.22. The FTSE 250 was at 8.75, and the FTSE 350, which is 7.43. That is the annualized return year on year. So over that period, you can see that's why the winter portfolio significantly outperformed. But I like Sharpe ratios. So anybody who listens to the podcast knows I like a Sharpe ratio, which effectively is a measure of the excess return you're getting for the risk you're taking. And the Sharpe ratio for the winter portfolio is significantly higher than all of the others at 0.58. Whereas, for example, the FTSE 250 is at 0.31. And also the volatility levels, because it's going into cash for half of the time, the volatility levels are only measured at 10.66 for the year. So the annualized volatility is 10.66 versus 15.19 for the FTSE 100, 16.78 for the FTSE 250, and 15.08 for the FTSE 350. The upshot is that the winter portfolio has performed strongly once again. Now, anybody who listened to last year's show would have heard me mention the Fidelity UK Smaller Companies Fund. Not a recommendation in any way, shape or form. If you're interested in it, then do go and do your own research. But I talked about how well it done previously, and it has always been a member of that winter portfolio. And this year, it actually rallied 18.51% in that 6-month period from the 1st of November 2023 to the 30th of April 24. And over the whole year, it was up 18.8%. So it basically went sideways for the rest of the year. So that just shows you the performance levels. And it's quite interesting because in the podcast last year, I said, it'd be interesting to see what that fund actually does, given that it got off to a good start ahead of Christmas last year. So there you go, Andy. The winter portfolio continues its impressive run. And we'll be back next year with an update to see whether it could continue that form into the future.